Hi, welcome back to the Confident Retirement Journey. I'm Craig Sullivan. Today, we're going to talk about something that happened very recently. April of this year, we've had one of the, let's say, most volatile times we've seen in quite some time, all revolving around tariffs. So let's talk about why we shouldn't worry about major market events, and instead, we should focus on the plan that we have to move forward. So as you see, the tariff fallout is what we're calling this, which was April 3rd and 4th, was the fifth worst two-day decline in the S&P since 1950. So we go back to the worst one being Black Monday in the 80s. We've got several of the dates from the 2008 crisis, etc. But the important thing to look at here is that with each one of these, the market finally did recover. And this has shown itself over and over again. So if we look at the global financial crisis, November 5th and 6th, dropped 10% in 2 days, so around the same amount, just slightly less than this recent experience. Within 1 year, the market was up 18.2%. That's pretty neat. If you look at all of these, it averaged a 2-day fall of 12.5%, with a year later, on average about 190 days to fully recover, but a year later, 28.3% up. So what's important to understand about this is we've got to make sure we have a plan. Don't react to quick moves in the market, right? Especially in today's information age, where markets are short-term driven by the latest headlines of the day. And as we saw with the tariff piece, and we're really still going through that at this particular time, the market can go either direction in big, wild swings, depending on what the headlines say that day. So let's take a look at what smarter investors are doing today and throughout history to make sure that we're staying on track. First is we got to make sure that we have a long-term plan, and more importantly, that we stick to it. We've got to be careful about making rash judgments based on headlines that are happening in big fluctuations in the market. If we're in a point of our lives that we're still contributing to plans, one of the biggest mistakes we see is when people get emotionally driven by the markets, maybe they stop contributing because they're nervous about losing what they're putting into it. But understand that if you've developed a good, solid plan, the plan's already accounted for short-term market swings. It's important to stick to the plan that you have in place. Staying diversified is very important as well. What we mean in this context is don't chase the latest headline, the latest sector that might be doing well. Sometimes we find that people, when things are going very well, they start chasing those that have been doing well rather than sticking to the plan of diversified investments throughout different arenas. And this last one is very, very important. Let's not overreact. Stay the course of your plan. We've got to make sure that emotionally we remove ourselves from investing. Now, this can happen in multiple different areas, in multiple different directions. Sometimes we see people get so nervous that they go to cash and just sit there and plan on staying there for a little while until things calm down. Unfortunately, trying to time the markets or trying to time the exact bottom of the stock market is all but impossible. Instead, we want to make sure we stick to the plans that we have in place and stay the course. On the opposite end, we've also seen people that get emotionally driven and think, oh my gosh, things are so on sale, I'm going to leverage everything. I'm going to go take out more of a mortgage on my house so that I can invest more money. While that may seem like a great idea, again, timing says we don't know when the market is going to be. Let's not take on more leverage just because we're feeling emotionally that that might be a good idea. The overall theme here is stick to your plans. If you don't have a plan, then it's really important that you work with somebody to get a good, solid plan in place. So what does staying focused look like? Well, understand that volatility is normal. It's nothing new. The market's always had swings. It's always driven by volatility in the short term, by emotions, by political things, by whatever's going on in the environment around us. That is a short-term driver in volatility in the stock markets. Again, it's not new. Discipline and perspective matter more than headlines. Understanding how your plan works, what it's trying to accomplish, and sticking to it is more important than anything that you're going to read on TV or read in a headline somewhere or listen to on some radio station or anything of that nature. When we do make changes, they need to be thoughtful and according to your plan, not emotional. Don't make a big change just because all of a sudden we're a little more scared or nervous. Also, don't make a big change just because all of a sudden we have a whole lot more confidence. See, that can go either way. It's important to make sure that the plan is being thought about and that your actions match the plan you have in place. If you don't have a plan, we're here to guide you through these uncertain times. When we work with a client to help them gain confidence for their retirement, we make sure that short-term volatility is accounted for when we build a plan. We know that these kinds of things are going to happen, and we account for it. If you don't have that, we'd love to walk you through our confident retirement journey with one of our advisors. Give us a shout. We'd love to see if we can help. Until then, remember to stay calm, even in the most volatile times. Keep thinking bigger. Until next time.